Well, right now, we've got a situation where you have very strong economic growth, strong earnings growth, and uh, obviously this does create pressure on interest rates, but the headline interest rate, the 10-year bond, is probably capped because there's so much demand from non-US investors to get that extra yield that they're getting in the US. So we're likely to see developed market yields going up, but not necessarily US 10-year yields going up. Now, this does raise pressure globally on yields, which is harder for emerging markets. So basically, we think that developed markets are likely to lead right now. And within developed markets, more of the cyclical sectors that are benefiting directly from growth, and particularly sectors like financials that are benefiting from higher term spreads. So those are the areas to be investing in, we think.
Andrew, Nancy and I have been discussing the hedge against inflation, even if it's transitory. And so what are you advising clients and how are you positioning yourself for that?
Well, a lot of investors have been worried about inflation, so many of the obvious hedges have already priced in, like the break-evens, for example, on the U.S. Inflation-linked Treasury notes are already pricing in a meaningful amount of inflation. So that's probably not really the place to go, I think. You have to keep in mind that companies themselves tend to over time, they haven't been doing it recently, but if inflation really becomes a persistent problem, and you obviously have to look at a longer term earning stream, inflation gets passed on into earnings. And so you have interest rates maybe going up, but earnings going up too by the amount of inflation. So the two things tend to offset each other. So equities aren't necessarily the wrong place to be in an inflationary environment because of that effect.